Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SYSCO CORP quarterly report. SYSCO Corporation offers a wide range of businesses and services to the food service industry. The company's distribution includes frozen foods, meat, seafood, prepared in trays, fruits, vegetables, and desserts, canned and dry goods. Various packaged products, fresh produce, meats, seafood, dairy products, beverages and specialty items, non-food items, plus paper products, disposable napkins, plates, cups plus tableware, glassware, silverware plus cookware, pots, pans, utensils plus restaurant equipment, and supplies plus cleaning supplies. SYSCO serves various food service venues, including restaurants, hospitals and nursing facilities, schools and colleges, hotels and motels, industrial caterers. The SYSCO Corp stock price has made no significant changes over the past year due to several factors. One reason is the company's consistent earnings reports, which have shown steady growth but not dramatic spikes or drops. For instance, in Q2 fiscal year 2025, SYSCO reported a 4.5% increase in sales and adjusted EPS, but this did not cause a major surge or drop in stock price. Another factor contributing to the lack of significant changes is the company's minor reactions to earnings reports. In Q3 fiscal year 2025, SYSCO missed both EPS and revenue forecasts, resulting in a minor decrease of only 0.13% in pre-market trading. Similarly, in Q4 fiscal year 2026, the stock declined by 1.28% despite beating Wall Street's EPS forecast. Additionally, analyst ratings and general market dynamics have not had a significant impact on SYSCO's stock price. Throughout the year, the company received various analyst ratings, with a consensus of buy from 12 analysts as of October 29, 2025. Price targets were often adjusted, but individual changes in ratings or price targets did not cause major immediate stock price movements. Overall, SYSCO Corp's consistent earnings reports and minor reactions to news events have contributed to the lack of significant changes in its stock price over the past year. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by increased sales, particularly in the U.S. Food service operations, plus $418 million, successful cost savings initiatives, 3.9% increase in gross profit, and strategic sourcing programs that led to a 5% increase in local case volumes. On the other hand, revenue decline can be attributed to net earnings decrease, minus 2.9%, increased restructuring and transformational project costs, and competition from group purchasing organizations, GPOs. Additionally, certain items such as statutory notices of deficiency and acquisition-related costs have had a mixed impact on revenue. Overall, the company's revenue growth is largely driven by operational efficiency and strategic initiatives, while revenue decline is primarily due to external factors such as increased competition and regulatory challenges. Net income and profit margins. A changing landscape. The financial summary reveals a mixed picture of net income and profit margins over the past few years. Net income has experienced significant fluctuations, decreasing by as much as $65 million in some periods and increasing by $168 million in others. The overall trend shows a decline, with net income decreasing by 2.9% to $476 million in page 32. Profit margins have also undergone changes. Gross margin increased from 18.2% to 18.4% in 2025, while operating income margin decreased from 3.9% to 3.8% in the same period. However, due to growth in local case volumes and strategic sourcing efforts, operating income margin has shown improvement. The reasons behind these changes are multifaceted. Restructuring and transformation project costs have had a positive impact on net income and profit margins, while acquisition-related costs have had a negative effect. Currency fluctuations have also negatively impacted sales, gross profit, and operating expenses. Overall, the financial performance of the company has been influenced by various factors, resulting in a complex picture of net income and profit margins. The company is generating significant positive operating cash flow, with a total of $1.123 billion in operating cash flow as of September 27, 2025. This indicates that the company's operations are producing more than enough cash to cover its expenses and investments, resulting in a substantial surplus. The consistent positive net cash provided by operating activities across multiple pages further supports this conclusion, suggesting that the company is on a stable financial footing. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, there is a mixed picture. On one hand, long-term debt decreased by $901 million from June to September 2025, page 2. However, this decrease was followed by an increase in total debt level by $100 million from June 28, 2025 to September 27, 2025, page 22. Furthermore, a more recent update shows that long-term debt decreased by 8% from $11,890 million to $10,898 million, page 49. Regarding interest expenses, there is a clear trend of increase. Interest expense increased by plus 6.25%, page 3, and the company reported an interest expense of $172 million in 2025 compared to $160 million in 2024, page 30. This represents a significant change of plus 7.5%. Additionally, interest expense has also increased by $12 million, 13.3%, from Cone F25 to Cone F26, page 40. Overall, while the company's debt level is somewhat inconsistent, its interest expenses have clearly increased significantly over the past year. The company's financial performance varied across different segments and regions. Notably, U.S. foodservice operations and SYGMA showed improved performance. However, other segments and regions struggled. International foodservice operations saw a decline in sales by 3% and operating income decreased significantly from $114 million to $25 million. The Americas and Europe also performed poorly, with no specific details provided for the other segment. Management's outlook on company strategy. The company expects to drive growth through key segments, product cost savings, and transformational projects. They anticipate growing both sales and net earnings per share in fiscal 2026, with a focus on delivering profitable and consistent growth through their Recipe for Growth strategy. While they expect SYGMA's sales growth rates to moderate in the next year due to reaching customer addition milestones, they remain confident in accessing capital markets and meeting cash requirements. Overall, management is optimistic about the company's outlook, citing a healthy growth market in the food-away-from-home sector. Acquisitions and divestitures overview. Our company has made strategic moves to enhance its operations through acquisitions and divestitures. Notably, we acquired $200 million in transferable tax credits from the Inflation Reduction Act, providing a significant financial boost. In addition, we expanded our business by acquiring Fairfax Meadow, a specialty meat supplier, in October 2025. This acquisition is expected to strengthen our supply chain and enhance our product offerings. On the other hand, we divested our Mexico joint venture in the second quarter of fiscal 2025. While this move may seem counterintuitive, it allows us to focus on core operations and allocate resources more efficiently. The company has paid dividends in the past few years. Evidence from various pages in the financial summary confirms this, including specific amounts paid in September 2025 and 2024, as well as fiscal year amounts for 2026 and 2025. However, there is no clear indication that the company has bought back shares, except for a mention of purchasing employee shares under an Employee Stock Purchase Plan, ESPP. Concerns about inventory buildup and supply chain disruption exist. The company's financial summary highlights concerns regarding inventory buildup and supply chain disruption. Specifically, the comparison of inventory levels shows unfavorable results, page 47. Additionally, the high cost of sales as a percentage of sales, 80.6% and 81% for U.S. foodservice operations, page 30, may indicate potential issues with supply chain operations. Furthermore, inflation rates have increased to 3.4% in the first quarter of fiscal 2026, page 33, which could impact inventory levels and supply chain operations. The company is also investing in supply chain transformation costs, pages 43 and 46, indicating potential disruptions in their current supply chain processes. These factors collectively suggest that the company faces challenges related to inventory buildup and supply chain disruption. That concludes the financial summary for SYSCO CORP. Feel free to comment below, and I will be happy to answer them when possible.